In today's video, I'm going to tell you everything you need to know about meme stocks and whether meme stocks are worth it, and if this little guide is going to be your secret to becoming a millionaire. And by the end of this video, I'm going to reveal to you how much money I made on the meme stock everyone is talking about, Gamestop. So, first of all, what is a meme stock? Well, have you ever woken up one day in the last decade or so and all of a sudden saw at least one of these images plastered all around your social media? Well, each one of these were all popular memes in the last decade. And to put it simply, a meme is an idea, behavior or style that is spread across the internet, usually through social media for a humorous purpose, between ordinary people just sharing their content and essentially making these images go viral. So what is the relationship between memes and meme stocks? Well, meme stocks essentially have the same concept. It's a stock that you all of a sudden hear about when you wake up that has generated a buzz from ordinary people sharing their interest in it, and essentially generating a viral buying frenzy into the stock market. And recently, this is exactly what has happened with companies like Gamestop, AMC and BlackBerry. But the thing to realize is that a meme stock is this label given to stocks, otherwise known as stonks, in the social world, where the share price skyrockets in value for no obvious business reason at all. So then, why and how does it happen? Let's take a deeper look into what happened with GameStop recently to understand why everyone went crazy in the investing world, and also why millions of people not investing started to get interested. So let's strip this down to the basics. So obviously, on the stock market, you can buy and sell shares in a company, and this makes the value of the company go up or go down. And the way in which the company's value will go all depends on the number one rule of selling anything: supply and demand. So if there is a demand for the shares, the value of the company will go up. And so typically, an investor will want to buy a stock when it is low and sell when it is high to make a profit. However, it is also possible for people to make money by betting that a company is going to go down in value. Let's see if I can put this in a different way to help you understand.
So now he's going to short the bonds, which means to bet against. Got it? Good.
So, betting against a company is what the investing world calls shorting a stock. Now let me try to help you understand what happened with GameStop. So let's say GameStop is this block of flats. Now let's say I own one of those flats in that block and its current market value is £200,000. But then someone comes to me and says, "Can I borrow that flat from you? And in a few days I'll give the flat back to you, but as a thank you, I'll also give you £5,000. So you're trying to tell me that if I give you my flat that I'm not using right now, and then in a few days later you'll give it back to me, and you'll also give me £5,000 on top of that? Seems like a no-brainer, right?" Yeah, exactly. Well, I guess you got yourself a deal. Now, the reason I want to do this is because I know that the value of this flat is going to go down in the next few days to £150,000. So what I'm going to do is actually sell this flat today for £200,000. Then I'm going to buy it back at the low value when it's £150,000 and make myself a £50,000 profit. Then I can give him back his flat plus 5k and I get to walk away with £45,000. Now, obviously, this is an exaggeration, but essentially, this is what multi-million-dollar investment companies known as hedge funds do on a daily basis, but they do it at a much larger scale. So rather than a few £100,000, they're using millions of dollars. So even with a small percentage of a drop, they can make significant gains. Also, by being able to sell a large number of shares in a company, these hedge funds can help drive the value of the shares down to their own benefit. However, if the price of my flat was to go up in value, let's say to £250,000, after Mr. Top Hat decides to sell it, I'll still be knocking on his door a few days later asking for my keys back. So Mr. Top Hat will be forced to buy the flat back at the current rate of £250,000 in order to give me my keys back, plus my £5,000, making Mr. Top Hat in a negative situation of £55,000. And basically, this is what happened with GameStop. So there's this Reddit message board called Wallstreetbets who noticed that GameStop, which is the American equivalent of shops like Game, or if you can remember Electronic Boutique from back in the days over here in UK. And GameStop has obviously been struggling during this pandemic with the closure of physical stores. But Wallstreetbets noticed that the hedge funds had also noticed this, and they were betting against the company. But Wallstreetbets also noticed that GameStop was actually being shorted more than the number of shares that even existed. How is that even possible? Well, what if when Mr. Top Hat sold my flat for £200,000, the person he sold it to then did exactly the same deal as Mr. Top Hat with someone else? This now means that Mr. Top Hat is looking to buy this property back at £150,000, but so is this other person as well. Now, in the case of GameStop, normally hedge funds can just about get away with these kinds of schemes. However, investors on the Reddit thread of Wallstreetbets saw what these hedge fund companies were up to and decided to take the opportunity to buy GameStop shares, hoping that it would push the price up and completely mess up the plans for all of these hedge fund companies. And guess what? They managed to succeed, as there was more demand for the shares than an actual supply. Because if you look back at the example of the flat, there are 3 people waiting for this one flat. And so, with GameStop, this ended up resulting in the hedge funds being forced to buy the shares back at larger prices, ultimately losing billions of dollars, where some of these independent investors happily managed to make a few $1,000,000 by driving the stock price up and selling it back to the hedge funds at that higher price. Then the same thing happened with other companies like AMC and BlackBerry. But this then sparked an uproar from independent traders, where some of the most popular trading platforms like Robinhood in US and Trading 212 here in UK restricted people from buying stocks like GameStop, which ultimately stopped the price of GameStop from going even higher, which made a lot of the independent traders frustrated, as it seemed as though these platforms were trying to protect the hedge funds. Now, the co-founder of Robinhood publicly said that these are requirements that exist to protect investors and the markets, and that it's their responsibility to comply with them seriously. Now, this is the issue with these modern day trading apps like Robinhood and Trading 212. They don't just allow you to trade in the way that I normally do, which is long-term investing. They also have an area in the platform where independent traders have the opportunity to leverage money in order to do exactly what the hedge funds are doing as well, therefore making it really easy for an average Joe trader with small amounts of money to get caught in the crossfire when the market goes against their favor, leaving them to incur really large costs. However, with independent investors, if they don't have the money to back their losses, there is a high chance that the trading apps will need to cover their shortfall. This is why these trading platforms have these policies in place where they can stop us from buying stocks. Now, the question then arises as to what the relationship is between the hedge funds and these apps. Now, obviously, I use Trading 212 and they execute all their trades through the largest brokerage firm, Interactive Brokers, who also have many hedge funds using Interactive Brokers as well. Now, personally, I feel that it would be very difficult to find out if the hedge funds have any influence on how Trading 212 is run. And normally, things like this will not affect me at all, because I usually invest in companies for the long run. However, I did have a moment of FOMO during this whole GameStop fiasco, and so I decided to throw in £100. But naturally, not being a trader, I caught wind of the story a little bit late. But luckily, or maybe it was unlucky, just after I put my buy order for £100 of GameStop, a couple of hours later, Trading 212 put a message up on the GameStop stock saying they will not be allowing customers to buy anymore, and they will only be accepting sell orders. And then since buying that £100 worth of GameStop, I've actually lost about 50%, as I didn't sell the stock at its peak. Now this is why I never usually get involved with day trading, because with a normal day job that has nothing to do with investing, I don't have the ability to be continuously checking on the markets. And I'm also not that active on social media to know when the next meme stock is going to blow up. Which is why I have decided I'm not going to be jumping on these bandwagons again in the future, unless I have more time to actually be able to watch the market and know and understand what is going on. Now at the end of the day, if you have the time and the money and the risk levels, meme stocks are definitely going to be a great way to make money. But at the same time, it is very, very risky, as it is so volatile. And the best advice that I've seen about this is that if you do invest in these kind of stocks, you should try to cash out your initial investment as early as possible, then continue to play the market with your winnings. But the takeaways for today are that Wallstreetbets have proven that the little guy can win in this industry that has predominantly been dominated by the big players for many decades. And this just means that the world of the stock market trading has now reached a pivotal point where investors with little money can make a huge impact. At the same time, if you are intending to do day trading, you have to keep in mind that you're going to be at risk of the app-driven trading platforms. If you choose to use them either because they will be trying to cover their own backs, being the little fish in the big sea, or also fall into the chance that they are also influenced by the bigger fish as well. But if you do plan to do safer long-term investing, I personally still feel that in UK, Trading 212 is still the best platform to use, and I'm still going to be using them as my platform of choice. And if you haven't got an account yet, feel free to use my referral link www.ganesh.co.uk/trading212, where you can get a free share worth up to £100 by just depositing at least £1. Now currently Trading 212 have set up a waiting list to join due to all the market activity over the last couple of weeks, but they should be up and running as normal very soon for any new customers. So you might as well join that waiting list. Now that's it for me today. I hope I've been able to help you understand what happened with Gamestop. And I'm definitely interested to see how many more other companies this happens to in the future. And if you manage to jump in on any of the meme stock waves, let me know in the comments below which ones you invested in and how much you made or lost. And if you're not subscribed to the channel already, head down to the red button and subscribe to the channel, and make sure you click on the bell button as well so you get notified when my next video comes out. And as always, like this video, comment down below and share with your friends and family. Peace and love to all of you. See you on the next video. Bye.